All right, folks, this is being recorded. Something I mentioned at the beginning of all my webinars is watch it again. Why? Well, I was thinking about it after last week's. Sometimes I do a brain dump, folks, and I can't stop myself. So it will help you to watch it again, especially if you're newer to trading. And some of the reasons why I'm doing those brain dumps is because I know when I'm looking at the attendance that there's some returning faces here. So, I'm trying to give them some something to take away as well. So for newer folks, you're probably going to need to watch it again. People that are newer to my videos, the reason why I like you to watch it again is because these nuances will stick in your head longer, all right? So I'm going to get you guys at the end of all of this to a place where options are going to just make sense. So smash that like button right now, all right? No, really, smash the like button. I'm kidding. On a serious note, I've geared this course to introduce traders and investors to options, and I'm sure this old floor trader can even teach the savviest of traders a thing or two. And options can be intimidating, but I'm going to build from simple concepts to real life examples. And by the end of all of this, you guys are going to be in a place where you understand options intuitively. And I think I can do that for you quickly. So let's get on with it, right? This section is wrapping up the section for bullish moves. We will, in the next section, start talking about bearish moves when we see those swing trade setups. So right now, a couple of days ago, there was all kinds of opportunities for bearish setups. Now, if you guys have been playing along this week, you've seen that sell-off today or yesterday and today. We were getting bottoming patterns and confirmations going on. So looks like the market is starting to change that momentum to the upside, which is a perfect opportunity for something like the long call diagonal. But we're going to break it down first. I want to first talk about swing trades, and then I'm going to dig into this long call calendar, when, where, and why it makes sense to implement a long call calendar over a bullish assumption, say, for instance, a call spread or something like that. I'm going to walk you through this logically as to what leads you down this road to finding the long call diagonal as being the best strategy for the assumption, all right? But first, for some of you newer people, let's talk about a swing trade real quick. What is a swing trade? A swing trade really is a trade that lasts longer than 2 days, all right? Lasts basically really more than 1 day, goes into 2 days. A day trade is that thing that happens during the day. You're in and out, all right? A swing trade is something that will last longer than 2 days or more, basically. But ultimately, what happens is we'll see in the markets that you can see these things gain momentum and lose momentum at any given time. So we'll see markets kind of do this type of move, or you might even just see them trade sideways, but they do have some different momentum swings within those or moving downwards, right? And ultimately what we're trying to do is determine the overall trend here first. So we could say that's a bullish trend or a sideways or neutral trend, and finally a bearish trend, right? Then what we're trying to do after that is look at this like with blurred eyes, if you will, is something I came up with the other day. And you will see where they have a tendency to have resistance or slow that momentum to the upside or slow the momentum to the downside, which is support. And I'll show you how to find this on different charts as well when you're going through it, but that's ultimately what we want to do. Find the overall trend, bullish, bearish, or market neutral. Find those support and resistance. They're going to be in there. I can show you different techniques to help you with that, but ultimately, the thing with blurred eyes, you'll be able to see them pretty easy. And then that will give us those support and resistances. And then we need to identify the pattern within the overall trend. In this case, we have a bullish trend, right? And you can see the market is rolling over into a bearish pattern within that trend. Here we would have a neutral trend with a bullish pattern within that trend, okay? So ultimately, we're trying to find those first things. There's 3 things that we're looking for. The trend, bullish, bearish, or market neutral. the support and resistances, look at it with blurred eyes, if you will, and then identify where this underlying is going within that overall trend, okay? Because they will have ebbs and flows in just about all markets. So for instance, if we were flipping through a chart, we could find one here and see that we have a neutral overall trend, right? And then you kind of look at the chart maybe with blurred eyes and say, all right, well, we can kind of go up and we're seeing it trade around kind of like that, right? Well, we can see that the overall trend is market neutral, and we can see these little support and resistance areas kind of if you looked at that with like blurred eyes, right? Before I started drawing all the lines in it, you could kind of start seeing that come to fruition. You're looking for patterns like that at the top of like moves for that momentum shift. All right. So, I like to look for hammers or hangman dojis, something like that, whether it's red or green, at the high or the lows of big moves. All right. Inside of a move, like in the middle of a move, it doesn't really have as much strength as something like what we would see in a situation like that, all right, or like this one, all right. Those are really huge signs of a bearish trend happening. Okay, so those are what we're trying to do. We're trying to ultimately look at how to swing trade. We need to identify that trend. Then we're looking to find those support and resistances, all right. They're not always perfectly obvious, but when you kind of look at it with the blurred eyes, or you have your Fibonacci's and things like that, that will help you. And then look for that pattern reversal inside that trend. Now, what happens? Sometimes what we're going to see is we've got a bullish move like this, and it looks like it's getting ready to roll over, and the next day it starts doing something like that, right? Well, it can happen anywhere, or you think it's going to start moving up and all of a sudden it starts rolling back over, right? I mean, the next day. Those things will happen. Now, the beauty in this is when these things break down on us, we can rely on the fact that, yes, we were looking at this trend going sideways, and we had our support and resistances, our sideways trend, and of course it breaks out to the upside, right? Well, what happens then? Well, if we're in this trade, we need to stay mechanical, and I show you how to do that, especially in the daily market commentaries. When the trades go against me, I show you how to dollar cost average, stay mechanical, lower that overall cost basis on trades that go against us, in particular something like IBM, right? And it pops up. But what happens a lot of times when we see that happen, this would have really panicked us out of like a regular trade, but when we get these moves in options, we can see it kind of when it breaks down at these upper levels. If we had options on, we might have been able to have a lot of things work in our favor rather than just directionality. When you are using the stock as the impetus of you making money, you really have to have that underlying move in your direction, or just stay right where you bought it, right? I mean, with options, you've got some wiggle room when things start going wrong that you can like stay mechanical with it and turn those tables back into your favor of getting a losing trade, as a winner. You can stay in them a little bit longer. I mean, for instance, with my Lulu trade that I was talking about before we started going, because I used options, I've been able to, ride out a trade that was going against me. Whereas if I had the underlying outright stock, I might have been a little bit more nervous on a swing trade that didn't immediately start working in my favor. All right. So I got a little ahead of myself. I'm sorry. Why options? Because like I said, we have better probabilities. Sorry. We have better odds. All right. Better odds of success using options because we can pick our strike locations better than just going to the market and buying that underlying. We can stay in these trades longer when they're going against us because we know our odds are better than what we had the otherwise. We will actually know our odds of success with with options. And it keeps your powder dry. You're going to stay confident a lot, and that will allow you to be in this trade for what seems like less angst than what you would normally have felt with a stock or an ETF outright in your underlying. Again, here we have a bullish trend, right? We can see that the market kind of makes some moves, but we can see where it's hitting support and resistances, right? We've got a bullish pattern inside of a bullish trend in this one, but that's ultimately what we're trying to do is look at these outrights and then try and find those support and resistances. And that's why I'm saying if you kind of look at it like right now with blurred eyes, you can kind of see where it was bumping up against areas over time. And that's what we're looking for when you're trying to swing trade, because that's where the momentum is losing steam, if you will, or when it comes down and hits these little lines, you know, that I've gotten lined up. Or you can look at the 50-day simple moving average, which is becoming more and more of a stronger indicator right now with SPY. But you can see bouncing up and away from that would be an obvious pattern move to the upside inside the trend there. Sorry, I went to the wrong thing. So I was flipping through the charts, which I do every single day, looking for any kind of setup, bullish, bearish, or market neutral. And we've got AT&T. So now think about this yesterday if you had gotten into this trade with, you know, what I'm going to right off the bat say is pretty decent volatility. But if you had gotten into this on that news, right, yesterday that came out basically was spinning off Warner Brothers and into spinning that off into Discovery, I think something along those lines, basically becoming a huge media company. Now, I talked about it in my daily market commentary. I don't think it's a great move. I think they should stay in their lane. They tried it once with Time Warner. It's not working. They're trying to spend their money, blah, blah, blah. But anyway, I'm looking at this on a technical move setup. The bad news is out as far as I'm concerned, that selling pressure to the downside is over. So I'm looking at this as a technical setup, and we've gotten this big move. Now this chart setup right there, that candle isn't normally a very good one to say that is my setup candle. You're not ever looking for that one. That's usually a candle that looks more along the lines of a continuation pattern. But when paired with a candle like this Hangman Doji after a big drop, right? That's kind of starting to signal that, hey, that momentum at the bottom here, that's, you know, people are finding value down there. And today I would say we're starting to look like we've gotten that confirmation to the upside. If you guys are familiar with trading around Stoudemire or market profile, which is what this is over here. Point of control really means where those lines are. That's where the market has found value for this particular underlying over the course of the last 52 weeks. All right. So that we always used to say is your magnet, because the market wants to migrate back to that. All right. That's where most people are comfortable. That's where it wants to be. So I think it will probably roll up. You know, let's just say I've got a long-term bullish assumption, but I think it might go up to this point of control where there's value. And you can see how it's in the past settled down in and around those little areas, right? That's what, you know, when you have those transactions happening, that's where people find value. So it's built up that area. So the volatility has a tendency to come out when we settle down in and around those type of areas. All right. So with all of that said, ultimately, I'm looking at this chart. It's had a big move to the downside. I'm long-term bullish in it. All right. I found this bottoming pattern for a swing trade. I think it's going to make a move higher over the long term. It might be a bit of a grind, though, with this one. I'm thinking with this, you know, when you're playing out a trade in your head, you know, if I was thinking this was going to snap to the highs again and it was just a ridiculous sell-off, I'd probably use a different strategy, all right? But on a strategy that you think is going to grind higher, or maybe have a soft move to the downside before resuming a grind higher, then that is what we're looking for in this trade. And last week we talked about it with the long call calendar, remember? And I was talking about it with the ETF for the Dow Jones Industrial Average, DIA. And I said, especially with the calendar, we wanted a little bit of a pullback probably before we resumed an upward trajectory for the long term. That helps out that strategy. That's exactly what we got with that long call calendars. We've gotten this little pullback in the Dow for that strategy I put on for that webinar, and it's working out like we would like to see in a situation like that. Now, I did look at it for this strategy as well, folks. So I didn't try, because I think that we're going to make another move to the upside in those indices. But with that said, it doesn't fit all of the things that I want to see for the long call diagonal. And I'll talk about those in a little bit here as we start getting into that. But all of those things said, when I'm looking at this trade, I'm looking at the chart here. They've had a big pullback. I'm thinking, all right, they've had a massive pullback, over a 10% pullback, which is good to see on something like this. That usually means there's going to be some momentum back to the upside. All right. But I think it's going to be a grind, and using options, I need longer durations for a longer duration, assumption. But if it's a grind and all of that, I've got a lot of things I've got to start thinking about with options, and we'll go over that real quick. But first, let's talk about some basic stuff with options so some of the newer folks will be able to play along here. When we're looking at options and trying to find the option strategy that fits us the best, we need to know what we're getting ourselves into, right? So the call buyer has the right, but not the obligation to buy the stock at the strike price, okay? So whatever strike that is, we're looking at in the options, if you buy, you pay the premium for that strike price in the calls, that gives you the right at any time to buy the stock at that strike price. Now, if the underlying is trading 100 and you buy the 120 strike in the calls, are you going to want to buy, that underlying at 120 when it's currently trading 100 right now? No. That's the beauty, and have the right but not the obligation. Now, if this underlying then tomorrow is trading 150 and you own the 120 call, do you want to buy that underlying at 120? Yes. There's a lot of value in that call then, right? So you can think of it like this. When you're buying an option, you are buying insurance. The insurance on a call is you're buying insurance on your fear of missing out, right? On the fear of missing out to the upside. If it doesn't happen, then you don't have anything to worry about. And on the put side, if you're buying puts, a put buyer has the right but not the obligation to sell the stock. Well, if you're buying puts, you're buying insurance on that drop, okay? The call seller, though, let's get back to the calls. The call buyer has the right but not the obligation to buy the stock. Well, the seller you can think of as the insurer of that, right? So if I'm selling calls, I have the obligation to deliver that stock to the call buyer, all right? If I don't own the stock in my portfolio, I am then short, okay? Short in my portfolio. I'm going to have to borrow stock, all right? And I will be short in my portfolio. And I mentioned this, the put buyer has the right but not the obligation to sell that stock at the strike price. We're not talking about just selling the stock at any price, at your strike price that you would have purchased, all right? So if the underlying fell from below where your put is, it gives you the right to sell way higher than where the current underlying is trading. So there is an immense value in that, all right? The seller of the put has the obligation to buy the stock at the strike in question, all right? So I would have to buy it at whatever strike when you're a seller of an option, okay? Just keep that in mind. Buyer is buying insurance. The seller is kind of the collector of the insurance. The seller, why would the seller want to do it? Because he knows those probabilities, all right? He's playing the probabilities, all right? Same as an insurance company. Your premiums are based on the probabilities of an accident, right? So it's the same idea there. All right. The thing we need to know, though, if we're buying options and we can sell options, we need to know if these options are expensive or are they cheap. The way we figure this out is through Vega. Yes, all right, I'm going to sneak in. We're going to sneak in the Greeks here, folks, but I'm going to give you some easy ways to remember this. Vega is volatility. All right? Or I'm just going to write both. But basically, volatility. And volatility, what we're looking for is implied volatility. Implied volatility. All right? So Vega is really just implied volatility. So when you're looking over at the options, we can figure out if our options are expensive, meaning all of the pricing over here in the calls or the puts, we can look at the puts, are these prices for these different strikes? This is where you would have the right but not the obligation to buy and or sell or buy the stock or sell the stock if you're buying calls or buying puts, right? So this is the premium associated to the strike. It's probably a better way to say it. All right. But we need to look at Vega, I said, right? There's Vega, and that is just implied volatility. Now, you'll see implied volatility in more locations than Vega. Vega is the only Greek that's not really a quote-unquote Greek. Over here, that you're not going to see it in a lot of different places. This is going to be one of the few ones that actually even has two names, really. It's implied volatility is Vega. That's all we need to know. And we're specifically looking at these percentage numbers, right? That will tell us if it's high or low. Now, if you're thinking, hey, I was just looking over at Tesla and I saw this Vega number at 60, so these prices are cheap, or the pricing is cheap. These are inexpensive. Well, yes, in comparison to Tesla, but we aren't in comparison to Tesla with this trade, right? We need to know where AT&T's implied volatility, or Vega, has been for itself, because what we will find is just like swing trades, the implied volatility will have these swing type moves inside of them. So we need to know where this number is, this 26, 25-ish area, is in relation right now to where the implied volatility for AT&T has been in the past, because they all have their like specific ranges they have a tendency to get stuck in. So on the chart, right, we've got this move happening, but this is where I want you to look. I put the chart in at the bottom, implied volatility, because I want to know where this number is right now, which we saw over there was right around 26. Okay, if I chopped this chart down and I cut it off, I'm sorry, I'll find it here in a minute. So as a matter of fact, this chart doesn't even give it justice of what this move looks like. So let's look at this one. This looks a lot better, right? Like a much better setup for a bullish move. But you can see right now, implied volatility, what I'm looking at right here, and it's 26 currently. So what I want to know is where this number is in relation, because you can see it's like a swing trade. It comes down to these lows and it finds support and goes up to these highs, and those are your resistances. Just like we talked about with these swing trades. I can look at this and say, well, it's inside that pattern, inside the trend is bearish. It looks like volatility is coming out of it a little bit, right? Well, yes, it does, but it looks like the premiums, to me, are really kind of cheap already. Trying to figure out where I am on my slides. I want to click on the wrong slide. How do I know? By quickly looking at this, where, if they're cheap or expensive, what I want to know is the range. So I'm looking at where 26 is in relation to the high and the low, and I can see that it's just slightly closer to that lower bar. And we'll drill down on this. So let's zoom in on that just to make it a little bit easier for you folks to see it. Let me get to the next slide. So let's zoom down there. So this is that same chart chopped down to about 6 months. So I'm trying to discount everything that happened back in and around the volatility we saw, last year. I don't think that we're going to see that volatility this year. I do believe volatility is going to remain relatively elevated. So I don't think we're going to see what we saw last year, and I don't think that we're going to see like the VIX in the low teens like we saw in years past. That's the next 6 months I'm speaking of. So looking at that, I want to know where this number is, and we already said it was 26, is in relation to this range. And over there it was 37 was this high, and basically we're going to call this low 18. All right. So we can already see from this chart that the current is closer to that bottom line there. So we know just based on this number that those premiums are relatively cheap. But if you want to really drill down on the numbers and know how you come up with all of this stuff, it's basically the current implied volatility, right, minus the low implied volatility on this chart, basically. And then you take that and do the high minus the low, all right? And what we're really just trying to do, sorry, I may have left something out. You're taking this sum and dividing it by this sum, obviously. And what it is you're just getting this number where we are right now in relation to the entire range. And what I say is this is basically the sell zone where you're selling option, and this is where you're looking to buy options. Now, we could say that it looks like this, bearish pattern coming out could hurt us. Why? Because volatility tells us if they're expensive. If volatility is way up here, we know one of the major determining factors of options pricing on any given day is volatility. Those prices are set at the beginning, but as volatility adjusts on any given day, our prices can go up and down, all right? It's not just an incremental, you're losing, to like one of the other volatility, or it moves up into gains in value all the time. This is going to, if the underlying goes down, we could see our options gain in value because of volatility. So we need to be hyper-focused on what volatility is doing, because that is going to determine our premiums on any given day, almost more so than the movement of the underlying, folks, believe me. So if we did all this math out, basically we would have 8 divided by 19, and that gives us somewhere around 43%. All right, so just slightly below 50. This is the line of delineation, 50%. That's your head scratcher, for folks. We don't know if it's necessarily going higher or lower here. So in a sense, I'm thinking they're cheap. On the cheaper side, I need to be thinking I need to buy them, but I'm also thinking I need to be hedging that idea a little bit, right? You guys getting the logic here, right? So how do I do that? Well, I'm definitely thinking about a strategy where I'm purchasing a bullish, probably a call, right? So I'm purchasing something, but I want to hedge it. How do I do that? Well, I'm probably going to look to sell something and take advantage of some of the volatility if it starts coming out. All right. I just want to make sure I got all my notes, because last week I felt like I missed out on a lot of notes. So that is one of the major things we determine if they're expensive or cheap. Another thing we want to look at when we're looking through the options is if I think that they're cheap, I know that I need to be thinking buy, right? And if I'm buying, we'll talk about it here in a minute, I need to be thinking about probably further duration options. But one thing I want you to note is this Vega number between all of them, or the ones in question, like the months that we're going to be like considering, right? All of these, we want to make sure there's not a major difference. And I like to say that my rule of thumb is it's a less than a 3% increase in volatility, because volatility affects further duration options more than the nearer duration options. Okay, that's a rule of thumb. That is a given. But what we will see is there's every once in a while some skew happening and stuff like that, some wanky things happening, and that's when we want to pounce. And when it gets less, then this is an opportunity, because when they're really tight, we know that the pricing is in line with each other, right? If I buy one and I sell another, then I can offset some of those prices, right? You can think of it as like, yo, I don't want to be paying, top dollar. If this increased by like 5 percentage points, let's say it was like 35 or something like that, or almost 10 percentage points, you would know these were super expensive. And if this was much lower, it'd be like I'm buying really expensive and selling it super cheap, right? So we want to look for an anomaly where they're really tight, okay? That is good. And we can see that these are really tight. It's not a major difference. It is less than 3 percentage point increase. Now, if you are ever looking through the options and basically you come across a situation like this, which I showed last week, where you can see this number is higher than these numbers way out on the curve for volatility. I mean, this is one of the biggest increases you will normally see, or bigger increases, and that's only like 2 percentage points. Actually, this was taken today, and it's come in a little bit. Last week, what did we see? We were seeing something where the underlying was only trading a little bit different. And look at the difference here. That was your opportunity to sell that really expensive volatility and buy it back much lower. All right. You could have even had this, move against you, and it would not have really hurt you that bad, to be honest. As a matter of fact, we could probably look at if you had sold like those calls, right, or the 210 calls, right, in the June. This market is 104 here, gone up by $6. And look at that. Those actually went down in value. Those are the those same calls, right? The volatility was really high here. And, this was a week or so ago. And then basically market moved against you and you would set yourself up for success, right? You see what I'm saying? That's why I'm talking about when you're using options, like this option in particular, just this one in particular from last week, it moved $6 higher, but this option actually, the short call or whatever, that call lost in value because that volatility coming out. And a little bit of theta decay, but the volatility was the major move. I mean, that was 8 percentage points. I can tell you that 8 percentage points was basically $2 of value coming out of those. All right. So anyway, back to our example. When we're trying to think of this particular example with AT&T, are they expensive? Well, they're cheap, but I'm a little worried about them getting cheaper. All right. So this is the whole logical setup here. We've gone through AT&T. I've got this bullish move. I think it's longer term. I'm worrying about it puttering down right now for at least a little bit, but longer term, I'm still bullish. I'm looking at the premiums. Yeah, they're cheap, but I think I need to maybe hedge that as well. All right. So we're going to think about buying options, but when we buy those options, we want to do it with a hedge. All right. I want to kind of hedge some of my exposure. Now, keep in mind, though, when we want to limit or we're hedging, that means we're limiting some of our risk. If we limit our risk, we are also limiting our reward. Okay. So just know that anytime you're getting something, you're kind of giving something up as well. It's just as life is too, right? All right, we do have to worry about the thief in the night, all right? And the thief in the night is not linear. It doesn't take 5 cents every single night. The closer and closer we get to expiration, that thief in the night gets really aggressive, all right? So remember when I was looking at that chart and saying the buy zone, sell zone for volatility? Well, in this, we're looking at this. These are our expiration cycles. The sell zone, really, I like to say, is probably closer to this, which is about 45 days. So, somewhere 45 days to 35 days. Whatever is close, 35 days to expiration is that real sweet spot, but you know, sometimes you will have to go further out is what I'm getting at here. You just want to get as close to 35 days to expiration as you can when you're thinking, I need to sell, or the premiums are expensive. And then you want to be getting out here for a buy zone. And I like to say that's somewhere outside here, you know, outside of like 70 days is kind of like what I like to look at as a buy zone. Because if it's inside of here and this is what's happening to our premiums, then if you're selling it, that helps you out. You want that to happen. You want to sell high and buy low. And if you can have theta, that thief in your night or the thief in the night that comes and steals your premiums on your side, then you want it. When you're buying, you kind of don't want him to know you're around, right? So if you want to buy, you want to get out. Yes, it feels like it's a little bit more expensive for those premiums, but you need to be a good steward of your capital and try to retain as much of it. You don't want it eroding when you buy, all right? We can see in an example like this with an Apple example, inside of 8 days, that was, you know, inside that real drastic drop off. This is 7 days, right? We really see that massive drop off. But when we look at going from 36 days to that 8 days, this is generally what's going to happen with our theta. You can see it's always negative. Every single night, theta comes and erodes our premiums. And right in this column tells us how much. Well, we can see 36 days out here. We can see it was only like at these strikes 4, 5, 6 cents, right? Every single night. Well, then we go throughout time and look, 30 days later, it almost has doubled. So in that time, it's slowly increasing, ratcheting up. It goes from 5 cents, 6 cents to 7 cents. And finally, we'll end up here at around 13 cents with 8 days to go. Well, what would happen if I got involved in a trade, you know, way out here? Look at the theta coming out is much less. And in the next 100 days, it only increases by a couple of pennies over the course of 100 days, right? This over doubled in the matter of 30 days. So don't be buying options when they're going to erode that quickly. Yes, you are going to have to pay a little bit more, but you're being a good steward of capital. It's not just, you're not just throwing it out the window. You're not turning the air conditioner on and then opening the window to smell the outside. All right. So with our example, it's a little bit cheaper of a stock, so it doesn't look nearly as dramatic, but know that we are dealing with smaller prices here as well. So it's still impacting you at, you know, that at the same pace, really. So we still want to be good stewards of our capital and make sure that we try to limit that. So if we're buying options, I don't have the August, so it's, you know, this 50 some odd days we showed in that last example, theta is going to start ramping up here pretty closely. So I'm going to go out a little bit further to that September. I would like to see, the August would be the perfect month, but we don't have those. They'll probably come out on Monday or something after the May expire. They'll release those, but we don't have them today, so we're not going to deal with it. All right, let's do a real quick review on my strategy, right? Before we get into it, I'm looking at a underlying that is making a bullish pattern inside an overall bullish trend, because I could say that this is an overall grindingly bullish trend. All right, I see I have cheap volatility, but I'm worried about that volatility coming out. All right, I am a little worried about some of that volatility coming out. So that is really what is getting me to think I got a cheap underlying. I want to buy a call because those premiums are cheap for my bullish assumption. And I think it's going to take a while, so I know I'm going longer duration still. But I want to hedge my problem with volatility coming out. Because if volatility comes out, my premiums go down. And if I buy something and my premiums go down, that hurts me. So I'm going to look to hedge some of my exposure on my long call by shorting a call to help finance some of that volatility and that theta, all right? Because theta is what will make an option expire worthless. Any option that is out of the money at expiration expires worthless. So any of these, a call above, right? Because if you buy a 33 call above where the underlying is trading at 29 at expiration, 1 day to go, do you want to buy it at 33 when you can just go out and buy it at 29? No. So they're worthless. Nobody wants to do that. So they're worthless, right? Same with a put. You want to sell AT&T at 27 when it's trading 29? No, nobody does. So it'll expire worthless, all right? Out of the monies will expire worthless. So we can take advantage of that when we sell that short call to finance it, all right? But let's talk about a little bit more about these options. Delta is the rate of change to an option premium. So when you're looking at that option montage, what it's really saying is this delta column, if this underlying goes up by $1 exactly, so now we're at $30.66, right? Moved up by exactly $1. Our premiums in our options, right here, let's look at the 31 calls, right? Going across, our premiums would increase by 22 cents. So the underlying, AT&T goes up to $30. We would see 22 cents go into these, and we would be looking at 45 cents at 46 cents. On that dollar move higher, our premiums would move up by that corresponding amount. But it also, more importantly, tells us what our probabilities are, all right? So when you're looking at the options and you're looking at, say, a 16 delta call, let's say these are the calls on this side and these are the puts because the puts are negative and the calls are positive, right? Underlying is trading right here on this day. Well, when we're looking at the options, it's also correlated to standard deviation. And this is a 1 standard deviation move. Well, in order for any of this to happen, we can add up these probabilities. The 9.2, the 4.4, the 1.7, the 0.5, the 0.1, the 0.1, all the way out to all those standard deviations, right? Well, you add all of that up, and basically you come up with a 16 standard deviation, or 16%. 16% is equal to a 1 standard deviation is what I meant to do, all right? Well, this is also delta. So it's equivalent to a 16 delta. So it means that this is 16% probability of happening. What does that mean this is? 84% probability of happening, okay? So when we're looking at all of these things, just know that when you're flipping through the options, you can look at it as probabilities as well. Like, yes, the underlying is going to increase to 46 cents. That, to me, isn't as sexy as knowing delta is telling me this option, this 31 call, has a 22% chance of being in the money at expiration. 29 days from now, I have a 22% chance of being in the money at expiration. All right? That's what delta also tells us as probabilities. Floor trader hack is 2 times the probability. Is your probability during 29 days that there is a 44% chance, 2 times the delta, that it will trade $31. In the next 29 days, there's a 44% chance that it will trade $31. All right? Those are just the probabilities. Probabilities are the probabilities. That will help you sleep at night. When this trade starts happening, you know, I knew what I was getting myself into. I had a 44% chance of getting hit. Well, all right, well, I got dinged on it. You can stay in it because it only has a 22% probability of being in the money at expiration. right? So the odds of it hitting you are 2 times greater. Odds of you seeing your strike trade in the open market is 2 times greater than the probability of it being in the money at expiration. Does that make sense? Everybody with me? It'll help you sleep at night. When it goes up there, you know, probabilities are half that of it being in the money at expiration. So you can sleep at night a little bit better. All right, so we talked about the long call diagonal. What strikes do we want to use? We want to use, I start with the long in the money call. And I like to start out with around the 84 delta, all right? This one I'm going to have to go at around the 36 delta. But what we look at here is this 84 delta is our kickoff point, all right? That has a really strong probability of being in the money at expiration. We also paying a premium for this 84 in the money option. It's going to be a little bit more expensive, but we also aren't going to have to worry as much about extrinsic value or that theta decay, the volatility, all right? If volatility starts coming out, we're going to try and finance, we're going to hedge that risk by selling this short call, all right? The short out of the money. This is, you know, we're going to be also looking for 35 days to expiration. Whoops, days to expiration here. The out of the money. This is that one. And this one, we want to be greater than like 70 days to expiration. All right. On the one we're buying. So 2 different monthly cycles. Anybody remember what the difference was between the call calendar and the call diagonal? That's right. The call diagonal or the call calendar had the same strikes. The call diagonal is 2 different months with different strikes, all right? So we want to go in there and look at our strikes. I said we start out at around that 84 delta. Well, I didn't have the 84 delta. I'm starting out at this set. So I had to go a little bit further in the money, all right? And the reason why, here's another floor trader hack for you. When we're buying this option that's in the money, okay, you can see we're paying $4, somewhere between $4.80 and $4.85, right? Well, the 25 strike that's in the money, I'm buying a call that is in the money, right? The call buyer has a right but not the obligation to buy that underlying at 25. Well, I have to pay $4.80 to be able to do that, right? And you're thinking, well, everybody would buy it at 25, right? Well, you got to pay $4.85 for it. So if I do that, then my break even is higher than where this underlying is currently traded, right? Because then it's at $29, $4.80 plus $25. We're talking about $29.80. It's higher, right? So that's where your break even is. What we do is we look at the corresponding puts, and you can see basically how much extrinsic value, that's how much theta is going to come out of these, all right? And that's the number we want to look for to try and pay off. I couldn't get exactly 30 cents. I went a little bit higher to get it at 24 cents, all right? So I'm paying off the extrinsic value. How do I know? Because I'm paying $4.59, right? You can see that debit I would be paying down here. Now, the way to find your break even is you add the $4.59 to 25, the strike that I'm able to buy the underlying at, right? And you add those all together, and you can see that puts me right at $29.60. So now I made it to where I'm actually buying this underlying below where it's currently traded. So I know that I've gotten my extrinsic value paid for. I know I've got it for its value. All of those things are working in my favor. And then I'm going to look to try and roll these out. Like if I can get these out for, you know, they expire worthless, then I'm just going to roll them out probably to this month here. All right, sell another call. Hopefully I can get higher, increase that spread width. Now, something to note with this strategy, we want to be less than 75% the width. All right, we want our debit to be less than 75% the width. Now, what you're going to do is you take $4.59, divide that by $6, and you're coming, and it's going to give you a 76.5. It is a little bit higher. Yes, it's a gray area there. It's very close. As a matter of fact, I searched tooth and nail for a perfect setup. This was about as close as I could get for a lot of things. With all things with the technical setup and everything coming together to work out perfectly. This is about as close as I could get. So try to make it 75% the width. Yes, I'm a little bit off on that, but when you're dealing with bigger numbers, right, when you're looking at $100 stock, this is going to be more and more important to make sure you stick to those levels, right? I've actually seen where you can set these strategies up, especially if there's a huge discrepancy in volatility where you're paying a ton of money for those back options as opposed to what you can get for those front options. I've seen it to where you are paying 100% the width of the spread, meaning I would be paying over $6 for the width of the spread. Don't do that. It's not worth it. That's why this volatility thing, I'm getting you to avoid that right off the bat with that less than 3% increase. You know, if you had 10% increase back there, and I'm talking about that Yelp thing where you're paying dollar signs way out in time, there are scenarios where, as a matter of fact, I can't remember what it was, but I did find one where it was pretty close. I was paying like $9.50 for a $10 wide spread. That's not very good. It was like 95% the width of the spread. All right, so stay away from that. Try and keep it less than 75%. Usually it will be right around there if you're following along with these guidelines that I've set for you as you're going along, all right? And when you set it up that way, know that you have limited risk to the downside because you're buying a call. Remember, if it goes down below my strike, if AT&T goes below 25, I'm a buyer of that option, the 25 call. I have the right but not the obligation to buy it at 25. If it's trading 20, I'm not doing it. I'm just going to let it expire worthless. So I have limited risk to the downside, as opposed to the stock. If you bought the stock and it gaps down, even if you had a stop on, your stop's getting executed on the gap. With options, you know you're out when you're getting into it, which is huge peace of mind. Now, your risk is limited, or your reward is limited though also, right? We want to limit some of our exposure to that volatility, so we sold the call against it. By doing that, we also limit our reward a little bit. That's only during the life of our short call, all right? After that, then we own this long call. We can go out there and roll it higher and out and do like a covered call strategy on that long duration call, which I highly suggest doing. But during the life of this, that is going to be our profit potential. You can see you would have a profit though. This is all profit. This is loss down here, all right? So you will have that set up to where you have the profit on the upside. Now, when you get out of this on swing trades, you saw what I was looking at. I was looking at a chart that kind of looked like this, not a very good candle, like that. And then I had another candle like this, which is not usually a great setup candle, but I got a very bullish move today after all of that stuff started happening, right? And the momentum to the downside really started slowing. And I'm trying to find my ink color while I'm talking to get it changed to green. And then we got a blast off to the upside here for my confirmation. All right. Now, with that said, because I'm doing it on a setup, the rules of thumb for a chart setup or a swing trade setup is you get out on the previous candle, that setup trade, not the confirmation one. All right. So in that case, we are going to be looking to be getting out below this low here. All right. That would be where I would say in our chart when we're looking at that AT&T trade, that would be kind of getting out right here below this setup is where I'm looking to cover it for a loss. I break down on that. I'm going to cover that trade. All right. Because I've already think we already gotten a little overextended at the downside. I think we're going to kind of slow down here at the point of control. You can see there's already value built up there. It's going to calm down a little. Might see that volatility come out and then resume to the upside. That's my whole thesis for this trade. Out below here, if it goes up there and hits my short call, you know, those are winning people's problems. All right. So I'm going to cover it. As soon as it hits my short strike, I'm going to cover that trade for a winner. All right. Anybody have any other questions real quick before we go? Nope, I don't see any. All right, you guys. What we're going to do, switching it up a little bit. Here you guys get our Wolfman Options Lab for taking the time out, hour out of your day. I'm going to give you guys access to over 15 hours of content here. We normally charge $900, almost $1,000 on this. We're going to give it to you guys for $36 today. Protecting your portfolio against rising interest rates, folks. That is huge. A half a basis point. We're right now at 0.25. They move it up to 0.75. That is painful to a bond portfolio. And if you are on fixed income, you need to know how to hedge those risks. Spotting trades using that market profile. I'm going to show you how to trade around market profile and how you set your trades up, what you're looking for. That's that blue over there on the side that I was looking at, and I pointed out was the point of control at one point in time. Streamline your process when using options. I'm trying to make it so you guys can really find that information quickly and easily. I don't want you guys having to think and look stuff up. I even tried to give you guys easy ways to remember the Greeks. You know, Theta is the thief in the night. So ultimately, what I want you to do is be able to walk away and say, I know when, where, and why I trade those options. All right. Specific options, long call spread, short put, all of those things for the same directional assumption. A lot more, tons of content. Thank you, Alexander. He said much precious information in all of those. I appreciate that. George, I see your question. Let me give it. I can't read it all right now. I'm trying to process thought. This is also what you'll be getting here. All of this stuff for $36. Can't beat it. And, you know, I can't even list everything on there. But finally, I want to thank you. It's over in this. We've been going back and forth in the chat window. It's over in the chat window right now, the link to this. So you guys can click on that and go straight to the checkout. Otherwise, you're going to have to punch this into your URL if you're watching it on tape delay. Also, if you have any questions, comments, or ideas for future webinars, reach out to us at 310-598-6677. or trading at protraderstrategies.com. One other thing I forgot to mention with this, you also get the history, which is a lot of fun. There's a lot of good stuff there. History, how to trade around gamma, but really what you guys can get if you guys take advantage of this is you can reach out to me, not only setting up your trading platform the way I do so that you can streamline your process. I have the script for implied volatility percent, that one that I gave you. It shows up in a lot of different places on your platform. But it gives you 52 weeks, all right? So when you're looking at your platform, it's going to give you the options, today's option statistics right down here. But this is implied volatility percent for the last 52 weeks. I have it so you can put it over here in the script, and it only gives you the last 6 months. So get rid of some of that stale data that might not really affect us going forward. So you guys can get that with this as well. Just reach out to us. All right, that's all I got for you, other than smash that like button for me, or if you can't take that, take it easy. Bye for now. All right, take it easy, JQ. If you're long in the money call, when you plan to roll the long short call at what delta? Good question, George. Rolling out in time and higher, I would probably try to go to somewhere between that 16 short delta to the 36. With the AT&T trade, I'd probably have to get a little bit more aggressive. But with something with like an Apple where it's trading, hundreds of dollars, let's say, then I would probably be leaning towards that 16 delta a little bit more. Good question. I wish I would have covered that. Yes, rolling out in time. You want to go still out to that short, 35 days to expiration and around that 16 delta. Great question. All right, you guys. Take care. Have a great weekend. Bye for now. You're welcome. Thank you. Appreciate all the kind words, you folks. Thanks. Yes, in the chat window. You got it.